Hey everyone, ever look at one of those financial charts and it just looks like a bunch of random confusing zigzags? Well, today, we're going to change all that. We are going to demystify the core tools of technical analysis by taking you on what we'll call a trader's journey. It's a step-by-step plan for spotting an opportunity from the very beginning to the very end. Okay, you ready? Let's dive in.
I absolutely love this quote from our source material because it just perfectly sets the stage. See, technical analysis isn't about having some crystal ball that predicts the future. Nope. It's about identifying setups that have a high probability of working out, spotting those potential explosions on the chart before they actually go off.
So every journey needs a direction, right? Before we do anything else, we have to figure out which way the market is generally heading. Is it going up? Is it going down? Or is it just kind of going sideways? This is our compass, and it is, without a doubt, the first and most critical step. And our main tool for finding that direction is the good old trend line. It's probably the most fundamental, most common form of technical analysis out there. It's simple, really. In an uptrend, you connect the bottoms, the valleys, and in a downtrend, you connect the tops, the peaks. Simple as that, but you have to get it right. Okay, now this slide lays out some simple but absolutely crucial rules. Look, anybody can connect two dots on a chart, but it takes a third touch of that line to really confirm that you've got a valid trend. And it's also key to remember that the steeper the line, the less reliable it probably is. But the most important rule of all, and this is golden advice, is do not force the line to fit. If it doesn't fit naturally, it's not a real trend. The market's trying to tell you something, and you need to listen.
All right, so once we know our direction, let's just say the market's in an uptrend. Our next job is to find the best place to jump in. This is our entry zone. See, trends don't just move in a straight line up. They move in waves. They push up, then they pull back a little, then they push up again. Our whole goal is to find the bottom of that pullback.
And to find that perfect spot, we use support and resistance. Just think of support as a price floor that's holding the market up, and resistance is the ceiling that's pushing it down. Now here's the key insight from our source material. You need to see these not as exact lines, but as zones. Thinking of them as zones helps you avoid getting faked out by these little quick moves that just poke through the level for a second.
Now, let's add another really powerful layer to this, the Fibonacci tool. It helps us pinpoint potential pullback levels. Now, you might be asking, why do these specific percentages even work? Well, it's not really magic. It's more about psychology. You have so many traders all over the world watching these exact same levels that they all put their orders there, and by doing that, they basically create the support or resistance themselves. It becomes a self-fulfilling prophecy.
And this is what happens when we combine our tools. When you find a historical support zone and it lines up perfectly with one of those key Fibonacci levels, well, that's what traders call a high probability entry area. Our source calls it a kill zone, an area where you can ambush the market with a pretty high degree of confidence. So, we've found our direction. We've pinpointed our high probability kill zone, but we don't just jump in blindly. Not yet. We have to be patient and wait for the market to give us a clear signal, like a flare gun that says the pullback is over and it is time to act now.
And that signal comes from these things called Japanese candlesticks. You know, each one of these candles tells a little story about the battle between buyers and sellers. A green or bullish candle means the price closed higher than it opened. The buyers won that round. A red or bearish candle means the price closed lower. The sellers won. And the size of the candle's body shows you just how decisive that victory was.
And right here, this is our flare gun, the hammer pattern. When we see this pattern show up right in our kill zone, that's a powerful, powerful signal. That long line at the bottom shows that sellers tried to smash the price way down, but the buyers came roaring back and pushed the price all the way back up. Like the source says, it literally looks like the market is hammering out a bottom.
So we're in the trade. Fantastic. But the journey isn't over, not by a long shot. In fact, you could say the most important part is just beginning. Having a great entry means absolutely nothing if you don't have a crystal clear plan for when you're going to get out, both if you're right and even more importantly, if you're wrong.
Your exit plan always has two parts. It's simple. First, where are you going to take your profits? You have to define what success looks like before you enter. And second, where are you going to cut your losses? That's your stop loss, the exact point where you admit the trade isn't working out and you get out to protect your money.
So, to set some logical profit targets, we can use another Fibonacci tool called extensions. These basically project potential levels up ahead where the trend might start to run out of steam. And just like the other Fibonacci levels, tons of traders are watching these spots to cash out, which helps make them pretty reliable targets.
And for managing losses, well, our source material could not be any clearer. I'm just going to read this quote directly because it is that important. Always use stop-loss orders, and never ever hold on to a trade just because of hope. Hope is a feeling. It's not a trading strategy. Your stop-loss is your safety net. It's what keeps you in the game to trade another day.
So there you have it. We've gone from a totally blank chart to a full-fledged, coherent trading plan. So let's just quickly recap the whole journey and see how each one of these tools played a very specific role in building our strategy.
What started as just a simple observation of a trend, it became a concrete plan. The trend line, that was our compass. Support levels and Fibonacci gave us the map to the kill zone. The hammer candlestick, that was our green light, our signal to go. And finally, Fibonacci extensions and a stop loss gave us our clear escape route. See, every single piece had a purpose.
At the end of the day, you have to remember that none of these tools can actually predict the future. They can't tell you what will happen. All they can do, is help you put the odds in your favor. It's all about measuring risk and identifying probabilities. So the final question isn't about whether the tools work. It's about you. Are you ready to think like a trader and play the odds?